Hey, what's up? Eric Garcia, certified financial planner and financial advisor. And in this video, what I'm talking about is the child tax credit change that came about as a result of the American Rescue Plan Act that recently was signed into law. Now, today is March 15th, 2021. This is a fluid situation. Congress passed this bill, and now people need to really figure out what's in it. This is all subject to change. I recommend that you always consult your accountant before you file your taxes if you do it on your own. I am not an accountant, full disclosure, but I want to talk about the changes in the child tax credit because I've been getting a lot of questions on it. But first, let me explain what a tax credit is. So people think of credits and deductions. A tax deduction reduces your taxable income. Okay, so before your tax is calculated, you can reduce it with a deduction. The child tax credit is a dollar for dollar credit that is applied to what you actually owe on your taxes. Tax credits generally are better than tax deduction. So child tax credit is a huge benefit to families with young children. All right, so to understand the changes in the child tax credit, we got to understand what's happening with the current law, because there's some families that will not qualify for the enhanced tax credit. So under current law, here's how it works. For every dependent child under the age of 17, you get $2,000 of credits applied to your taxable, applied to your taxes. Okay, so at $400,000 of income, adjusted gross income. So adjusted gross income is really important here. If you look at your 2019 tax return, that's going to be line 8B. Line 8B is that AGI, that number that so much of the stuff is calculated on. It also impacts your stimulus payment, so the AGI is really important, line 8B. So if you file jointly over $400,000 of AGI, you start to get phased out of the $2,000 credit. That's current law. $200,000 of filing single, you start to get phased out, current law. Okay. Also under current law, $1,400 of the credit is refundable. So for lower income Americans, if their tax liability is so low, they can actually get the credit back in the form of a refund when they file their taxes, as long as they have at least $2,500 of earned income. So that's the old law. The new law, let me just say this real quick, not every American is going to qualify for the enhanced amount. All right, so AGI is now based off of $75,000 for filing single, and then $150,000 filed jointly. You start to get phased out pretty quickly of this enhanced benefit. So keep that in mind. But here's the main differences in the law. Now 17-year-olds qualify. So prior it was 17, it was under 17. Now 17-year-olds qualify for the credit. Also, the big change is it went from $2,000 to $3,000. That's pretty significant. And if your child is 5 and younger, that $3,000 is now $3,600. So again, that's a pretty significant benefit to families. Also, the $2,500 earnings floor is removed. So if you have zero earned income, you can still qualify for the tax credit. Not only can you still qualify for the tax credit, but 100% of it is refundable. So if you have zero tax liability, you can actually get the money back in the form of a cash payment or in the form of a refund when you apply your taxes. Or for a lot of Americans who qualify, the IRS is talking about actually advancing the child tax credit to you. Again, this is fluid. We don't know the details, but starting in July is what they're saying, that you will be advanced if you qualify up to 50% of the benefit over a 6-month period. So from July to December, there's a chance that you actually get an advance of the credit, whereas before you had to wait to apply for your taxes. Now, be warned, okay? Traditionally, or typically in the past, the credit is applied when you file your taxes. So if you owe $5,000 in taxes and you have one kid and the credit's applied to what you owe, your accountant or your tax preparer comes back to you and says, hey, instead of 5, you only owe 3,000. If this credit is advanced to you, it is no longer applied when you file your taxes because it's already been given to you. So be diligent and prudent and wise and put some of that money to the side, potentially, if you're able to, because you're going to have to pay taxes, not on that money, but remember that money was being used and applied to your taxable to your tax liability when you filed. So that's the changes in the law. Again, my big warning is that money that was typically applied when you file is not going to be there if they advance it to you. They've already given it to you to spend on living expenses, not to put towards your taxes. So be warned there. Plan wisely with that. Look, if you have any questions about this, about any other financial topics, don't hesitate to shoot me an email. I'd love to answer your questions. I'd love to answer them in one of these videos. Thanks for watching.